For most people, market crashes feel sudden. One day prices are stable. The next, volatility explodes. Headlines appear overnight. Panic seems to come out of nowhere. But markets do not break suddenly. They break quietly. Long before prices collapse, something more important begins to fail beneath the surface. Something invisible to most investors. Something that rarely makes headlines until it is already gone. Market structure. Every major financial crisis in modern history followed the same pattern. Not the same trigger, not the same asset, but the same internal breakdown. Liquidity thinned, risk concentrated, confidence quietly eroded, and by the time the public noticed, the system was already unstable. Today, many of those same conditions are reappearing, not in the same form, not with the same names, but with the same underlying mechanics. This is not a prediction. This is not a forecast. This is an examination of structure, because markets do not collapse when people expect them to. They collapse when they are no longer able to absorb stress. To understand what is happening now, it is necessary to understand how markets actually function during stable periods and what changes when stability begins to disappear. In healthy markets, price movement is supported by depth. There are buyers willing to step in. There are sellers willing to provide supply. There is confidence that trades can be executed without large distortions. This is what creates the illusion of safety. But safety in markets is not permanent. It is conditional. It exists only as long as participants believe that liquidity will remain available. When that belief weakens, behavior changes, not dramatically at first, quietly. Risk managers tighten limits. Market makers reduce exposure. Funding becomes more selective. Leverage becomes more expensive. None of this appears in headlines. Prices may even continue rising during this phase. In fact, they often do, because late-stage markets are driven less by fundamentals and more by positioning. Capital flows into what has worked. Strategies crowd into the same trades. Correlation rises across assets. What looks like strength is often fragility in disguise. This pattern repeated before the 2000 technology collapse, before the 2008 financial crisis, before multiple regional and sovereign crises that followed. In each case, the system appeared resilient on the surface while becoming brittle underneath. The reason is structural. Modern markets rely on continuous liquidity. They rely on the assumption that risk can always be transferred. They rely on leverage functioning smoothly. When any one of these components weakens, the entire system becomes vulnerable. And today, multiple components are under strain at the same time. Liquidity is thinner than headline indexes suggest. Market depth has declined across major asset classes. Volatility spikes are becoming more frequent and more violent. At the same time, leverage has not disappeared. It has simply shifted. Where leverage once sat on balance sheets, it now sits in derivatives, in passive flows, in systematic strategies. This makes risk harder to see and harder to control. When stress emerges in this environment, it does not spread slowly. It transmits instantly. Small disruptions propagate through interconnected systems. Feedback loops amplify movement. Forced selling accelerates declines. And by the time policymakers respond, damage has already occurred. This is not theoretical. It is how modern markets behave under stress. The most dangerous periods are not those filled with fear. They are those filled with confidence, because confidence encourages concentration, and concentration creates fragility. Late cycle markets share several characteristics. Valuations become less sensitive to fundamentals. Narratives replace analysis. Liquidity becomes assumed rather than measured. Investors stop asking whether markets can absorb risk and start assuming they will. This assumption holds until it doesn't, and when it breaks quickly. What makes the current environment particularly fragile is the combination of tight liquidity conditions and elevated risk exposure. Interest rates remain restrictive relative to the last decade. Funding costs have increased. Central bank support is no longer unconditional. At the same time, markets are priced for stability. This is a contradiction. Historically, when liquidity tightens while risk remains elevated, markets experience instability, not always immediately, but inevitably. The early signals are subtle. Bid-ask spreads widen slightly. Depth disappears during stress events. Volatility reacts disproportionately to small shocks. These are not random fluctuations, they are warnings. In previous cycles, these warnings were ignored. In 2007, credit spreads widened months before equity markets collapsed. In 1999, volatility behavior changed before valuations peaked. In 2019, funding markets showed stress before global disruptions followed. Each time the narrative was different, but the structure was the same. Markets became less able to absorb pressure. Today, similar signals are emerging across multiple systems: equities, credit, rates, derivatives. This does not mean a crash is imminent. It means the system is becoming less resilient. Resilience is what determines whether shocks are absorbed or amplified. Without resilience, even small events can trigger outsized consequences. That is how quiet breakdowns become visible crises. The most important question is not what will cause the next disruption. It is whether the system can withstand one. History suggests that when markets reach this stage, they rarely regain resilience without a reset. That reset can come in many forms: a repricing, a liquidity event, a policy intervention, but it always involves adjustment. Markets do not move from fragility back to stability without pain. Understanding this does not require predicting outcomes. It requires recognizing structure, because structure determines behavior, and behavior determines outcomes. This is where the current environment becomes dangerous, not because of a single risk, but because of how many risks depend on the same assumptions. Assumptions about liquidity, assumptions about funding, assumptions about correlation. When those assumptions fail, markets do not decline gradually. They reprice, quietly at first, then all at once. For decades, markets were built around human decision-making. Risk was evaluated slowly. Trades were executed deliberately. Liquidity providers adjusted positions based on judgment and experience. That world no longer exists. Today's markets are dominated by systems, algorithms, rules-based strategies, passive flows, derivative-driven positioning. This shift has fundamentally changed how markets behave under stress. In the past, when volatility increased, humans stepped back cautiously. Now, when volatility increases, systems respond instantly. They reduce exposure, they de-lever, they sell, not because of fear, but because that is how they are programmed. This is the core structural risk in modern markets. The same mechanisms that provide efficiency during calm periods create instability during stress. When conditions are stable, automated systems supply liquidity. They compress volatility. They smooth price movement. But when volatility crosses certain thresholds, those same systems withdraw. Liquidity disappears precisely when it is needed most. This is not accidental. Risk models are designed to protect capital. They reduce exposure when uncertainty increases. They respond to volatility, correlations, and price momentum. Individually, this makes sense. Collectively, it creates a problem, because many systems respond to the same signals. When volatility rises slightly, one system reduces exposure. That reduction pushes prices lower. Lower prices increase volatility. which triggers more systems to reduce exposure. This feedback loop accelerates movement. What begins as a modest adjustment becomes a cascade. This dynamic is particularly dangerous in highly leveraged environments. Leverage amplifies returns during stable periods. But it also amplifies losses during stress. When leverage positions move against participants, margin requirements increase. Positions must be reduced. Assets must be sold. Forced selling has no regard for valuation. It does not care whether prices are fair. It only cares about survival. This is how liquidity crises form, not because everyone decides to sell at once, but because systems force selling simultaneously. The structure ensures it. Derivatives play a central role in this process. Options, futures, and swaps allow market participants to gain exposure without owning the underlying assets. This increases efficiency, but it also concentrates risk. Large positions can be built with relatively little capital. Exposure becomes opaque. Risk becomes distributed across multiple layers. When markets move, these layers interact. Option hedging flows accelerate price movement. Volatility targeting strategies rebalance. Risk parity portfolios adjust allocations. None of this is discretionary, it is automatic, and it happens at machine speed. This is why modern market declines often feel abrupt. There is little time between stability and disorder. The transition is not linear, it is structural. Another key vulnerability lies in correlation. During calm periods, assets appear diversified. Equities behave independently. Sectors rotate. Strategies generate uncorrelated returns. But under stress, correlation rises. Assets that appeared unrelated begin moving together. Diversification fails. Losses concentrate. This is not coincidence. It is structural convergence. When systems reduce risk, they do so across portfolios. They sell what they can, not what they want to. Liquidity determines what moves first, then correlation spreads. This is why crises often affect assets that were not directly involved in the original problem. The shock transmits through the system. In previous decades, central banks acted as stabilizers. They provided liquidity, they reassured markets, they intervened quickly. This created an expectation, an assumption that severe dislocations would always be met with support. That assumption shaped behavior. Risk-taking increased, leverage expanded, valuations adjusted upward. But this support is no longer guaranteed. Policy constraints have increased. Inflation considerations limit intervention. Political pressures complicate responses. Markets are beginning to realize this, not consciously, structurally. Risk premia are adjusting. Volatility is becoming more sensitive. Liquidity is becoming more conditional. This transition is uncomfortable because markets built on stability struggle to adapt to uncertainty. Participants accustomed to low volatility are less prepared for regime shifts. And regime shifts are structural. They do not announce themselves clearly. They emerge gradually, then dominate suddenly. The most dangerous phase is not the collapse itself. It is the transition, the period when systems remain positioned for stability while conditions deteriorate. This is when small shocks cause disproportionate reactions, a funding disruption, a geopolitical event, a policy surprise, individually manageable, collectively destabilizing. In such environments, markets become fragile, not because participants are irrational, but because structure amplifies movement. Understanding this requires moving beyond narratives. It requires examining how risk is distributed, how liquidity is supplied, how systems interact. And today, many of these components are aligned in ways that increase vulnerability. This does not mean outcomes are predetermined, but it does mean that stability should not be assumed. Markets can remain fragile longer than expected, but when adjustment comes, it rarely unfolds gently. It unfolds structurally, quietly at first, then all at once. This is the nature of modern market breakdowns. Not dramatic until they are unavoidable, not obvious until they are irreversible. For most of the cycle, these structural weaknesses remain hidden. Markets continue to function. Prices move within familiar ranges. Confidence remains intact. This creates a dangerous illusion, the illusion that the system is stable. In reality, stability at this stage is often a byproduct of positioning rather than strength. When markets are crowded, movement slows. When everyone holds similar exposures, volatility compresses. When liquidity is abundant, fragility is masked. This is why late cycle environments often feel calm. Calm is not the absence of risk, it is the concentration of it. As cycles mature, risk becomes increasingly centralized. Fewer trades drive more of the market's movement. Fewer participants provide liquidity. Fewer strategies dominate flows. This concentration increases efficiency in the short term. It reduces resilience in the long term. Resilience depends on diversity of views, diversity of strategies, diversity of capital. Late in cycles, diversity declines. Consensus strengthens. Narratives harden. Alternative positioning disappears. This is not ideological. It is mechanical. When certain strategies outperform consistently, capital flows toward them. When capital flows toward them, they grow larger. When they grow larger, they influence prices more strongly. This feedback loop creates dominance. Dominance creates fragility. Because dominant strategies must unwind when conditions change. And when they unwind, they do so simultaneously. History illustrates this clearly. Before the technology bubble burst, capital concentrated heavily in a narrow group of companies. Before the housing crisis, leverage concentrated in a specific segment of credit markets. Before many sovereign crises, exposure concentrated in government debt. Each time the system appeared robust. Each time the concentration became the point of failure. The modern environment exhibits similar traits. Capital is heavily concentrated in index-driven strategies. Volatility control mechanisms dominate risk allocation. Derivatives concentrate exposure in unseen ways. This concentration is efficient under stable conditions. It becomes dangerous under stress. When volatility increases, volatility targeting strategies reduce exposure. When exposure is reduced, prices move. When prices move, volatility increases further. This loop accelerates. Passive flows amplify it. Index-based investing removes discretion from allocation. Capital flows follow prices, not fundamentals. When prices rise, capital enters. When prices fall, capital exits. This behavior intensifies market movement. It does not stabilize it. In isolation, each mechanism is logical. Together they create instability. Another critical factor is liquidity illusion. During calm periods, liquidity appears deep. Order books look full. Spreads are tight. But this liquidity is conditional. It exists only when volatility remains low. When volatility spikes, liquidity vanishes. Market makers reduce size. Algorithms widen spreads. Depth disappears. This happens faster than most participants expect. By the time liquidity withdrawal is visible, it is already advanced. This creates the perception of sudden collapse. In reality, the collapse is the revelation of fragility. Late cycle markets are particularly susceptible to this dynamic because they rely heavily on short-term liquidity. Long-term investors become less active. Short-term participants dominate. This shifts the market's character. Short-term liquidity is more sensitive to volatility. It withdraws more quickly. This increases instability. Another factor is balance sheet limitation. Financial intermediaries have finite capacity. They cannot absorb unlimited risk. During stable periods, balance sheets expand. During stress, they contract. This contraction removes liquidity. It is not a decision. It is a constraint. Regulatory requirements reinforce this behavior. Capital rules limit risk-taking. Stress tests encourage conservatism. Balance sheets shrink when volatility rises. These mechanisms protect institutions individually. They destabilize markets collectively. This is the paradox of safety. Measures designed to reduce risk at the micro level increase risk at the macro level. Late-stage environments reveal this paradox. Participants act rationally within constraints. The system behaves irrationally as a whole. Another underappreciated factor is time horizon mismatch. Long-term assets are funded by short-term capital. Short-term capital is sensitive to conditions. When conditions deteriorate, funding withdraws. Assets must be repriced. This mismatch is inherent in modern markets. It cannot be eliminated. It can only be managed. Late cycles stretch this mismatch. Participants extend duration. They rely more heavily on rollover funding. They assume continuity. When continuity breaks, adjustment is swift. This is why late-stage dislocations often feel disproportionate. Small changes trigger large reactions. The system is optimized for continuity. It struggles with disruption. Psychology amplifies these structural effects. Confidence delays adjustment. Denial extends vulnerability. Narratives justify exposure. By the time fear emerges, structure has already shifted. Fear does not cause the breakdown. It follows it. This distinction is important. Blaming psychology alone misses the underlying mechanics. Markets do not break because people panic. People panic because markets break. The sequence matters. Late cycle. Environments also exhibit narrative rigidity. Participants anchor to recent success. They extrapolate stability. They dismiss warnings. This rigidity slows response. When response finally comes, it overshoots. Adjustment becomes violent because it was delayed. History shows that systems prefer gradual adjustment. When gradual adjustment is avoided, abrupt adjustment occurs. This is not punishment. It is consequence. The most important insight is that breakdowns are rarely caused by one factor. They emerge from interaction, liquidity, leverage, structure, behavior. When these align negatively, outcomes accelerate. The current environment exhibits many of these alignments. This does not guarantee immediate collapse. It increases sensitivity. Sensitive systems react strongly to small disturbances. This is why late cycle markets feel unstable, not because of visible weakness, but because of hidden fragility. Understanding this shifts perspective. It reduces surprise. It reframes volatility. It emphasizes preparation over prediction. The system is not broken because it is weak. It becomes fragile because it is optimized. And optimization without redundancy is unstable. This is the quiet reality of late cycle markets. Not chaos, structure. In every market cycle, there comes a moment when structure matters more than narrative. At that point, prices stop responding to stories and start responding to constraints. Liquidity becomes selective. Risk becomes expensive. Confidence becomes fragile. This moment is not announced. It arrives quietly. Markets do not collapse because participants suddenly lose faith. They collapse because systems reach their limits. Limits of balance sheets, limits of leverage, limits of liquidity. Once those limits are reached, adjustment follows. History shows that late cycle breakdowns are not chaotic by nature. They are mechanical. They follow rules that were embedded long before stress appeared. When leverage is high, small price movements matter. When liquidity is thin, exits narrow. When positioning is crowded, reversals accelerate. None of this requires panic. It only requires constraint. The most important realization is that markets are adaptive systems. They respond to incentives. They respond to pressure. They respond to scarcity. When liquidity is abundant, risk-taking is rewarded. When liquidity contracts, risk-taking is punished. This shift feels sudden because incentives change faster than behavior. Participants positioned for stability struggle to adapt to instability. Strategies designed for low volatility fail in high volatility. Assumptions built on continuity break under stress. This is not a failure of intelligence. It is a feature of complex systems. Complex systems appear stable until they don't. The transition from stability to instability is not gradual. It is non-linear. This is why late cycle environments are dangerous, not because collapse is inevitable, but because outcomes become unpredictable. Small events can have large effects. Unimportant news can move markets significantly. Minor disruptions can trigger systemic reactions. This unpredictability is the hallmark of fragility. Fragile systems do not absorb shocks. They transmit them. Resilient systems absorb shocks. They dampen them. Late-stage markets are fragile because they have optimized away resilience. Redundancy is costly. Slack reduces returns. Efficiency is rewarded. Over time, efficiency dominates until it becomes a liability. History does not suggest that fragility leads to permanent decline. It suggests that fragility leads to reset. Resets are uncomfortable. They involve repricing. They involve loss. But they also restore balance. After liquidity-driven adjustments, markets often emerge healthier. Leverage is lower. Risk is better priced. Behavior becomes disciplined. The cycle begins again. This is why cycles persist. Not because participants forget, but because incentives change. As conditions stabilize, risk-taking returns. As returns improve, leverage increases. As leverage increases, fragility builds. This is not moral failure. It is systemic behavior. Understanding this reframes market stress. Stress is not an anomaly. It is a signal that structure is adjusting. For observers, the challenge is not prediction, it is interpretation. Interpreting whether movements are driven by fundamentals or by structure. Interpreting whether volatility reflects information or constraint. Interpreting whether liquidity is abundant or conditional. These distinctions matter. They determine how markets behave next. Late cycle environments test discipline. They test patience. They test assumptions. They reward those who respect structure and punish those who ignore it. This does not mean avoiding markets. It means understanding them. Understanding that liquidity is not guaranteed. Understanding that leverage magnifies outcomes. Understanding that calm can be deceptive. The most dangerous belief is that stability is permanent. History rejects that belief repeatedly. Markets evolve through cycles. Liquidity expands and contracts. Risk is taken and repriced. Each cycle leaves traces. Those traces are visible to those who look beyond headlines. The current environment carries familiar signals, not identical to the past, but structurally similar. Liquidity is more conditional. Volatility is more sensitive. Market depth is thinner. These conditions do not predict outcomes. They shape them. What happens next will depend on interaction. Interaction between policy and markets, between structure and behavior, between confidence and constraint. No single event will define the outcome. Adjustment will occur through accumulation. Pressure builds, tolerance narrows, repricing follows. The process may be slow, it may be uneven, it may be abrupt, but it will reflect structure. The quiet breaking of markets is not dramatic. It is subtle until it is not. By the time disruption becomes obvious, the process is already advanced. That is why preparation matters more than reaction. Preparation is not fear. It is awareness. Awareness of how markets function beneath the surface. Awareness of how liquidity behaves under stress. Awareness of how systems respond when conditions change. This awareness does not eliminate risk. It contextualizes it. And context is the difference between surprise and understanding. Markets will continue to move. Cycles will continue to turn. Liquidity will return, as it always does, but it will return on different terms. Those who recognize structure adapt. Those who ignore it are forced to react. That distinction defines outcomes. Not timing, not prediction, but understanding.